Okay, we are finishing off Chapter 7. We're on page 10 and we're talking about Part B, the sale of receivables or factoring. So, when companies have a lot of receivables and need their money or choose to have their money now, they can sell or factor those accounts receivables to other companies that will buy them and collect the receivables themselves. Now, usually the company selling receivables will usually have a loss. They can be sold without recourse. So the purchaser or the factor is fully responsible for the collections. If it turns out one of the big customers can't collect, they went bankrupt or whatever, too bad, so sad. That's their loss as the purchaser or the factor. Where does it say with recourse? Well, if it's sold with recourse, the factor keeps some of the money he would have paid the seller. For things, So with recourse, the factor keeps some of the money he would have paid the seller for things like unpaid accounts. Seller records any proceeds as due from factor, so this money would be retained proceeds, that's a receivable, and that's sales discounts, sales returns and allowances, and so on. Usually it's a loss, and any recourse liability, if they're sold with recourse or a seller's guarantee, you have to record that. Okay? So, I sell you my receivables. You give me some money, and obviously I'll probably sell it at a loss because you're not going to give me more than normal. And that becomes a finance expense to me, and it becomes revenue to you if you collect all the receivables. If it's without recourse, you can come back to me and say, you know what, one of your big clients didn't pay up. I'll go, well, sold it without recourse. Now, obviously, I wouldn't get as much money from you if it's without recourse. But if it is with recourse, then you can come back to me and say, one of your guys didn't pay, so that money I kept of yours, I'm not giving it back. I'm only giving half back because half of it was from your client that didn't pay. Okay? And obviously, you'll pay me a premium for receivables if it's with recourse. Okay? Now, you don't need to know this in detail. You just have to be introduced to the idea that companies sell their receivables to other companies, and they go on and collect on it. Okay? For example, and this is just in my mind because I was on Reddit the other day, and I was reading about healthcare and people's experiences with it in the States, because I'm interested in that. And so the hospitals, what they do very quickly is sell their receivable from their customers to other companies, and finance companies are the ones hunting them down, trying to get them to pay, and so on. And just say it in that way because I really, really like the idea of healthcare for everyone. But anyway, so that happens a lot in the States. It happens with all kinds of different companies. You might just be short, like right now, going through COVID, people might be wanting, businesses might be needing their cash, right? Cash is king, right? And so there's more likely selling off of receivables now, but of course you're not going to get very much because other businesses are in dire straits too, and consumers, and it's just kind of a big mess right now. Anyway, so you just have to understand the basic principle. I'll show you a basic entry on one. And I think I've given one problem to do. It's not really important because really receivables and factoring can get very tricky and complex. So we just want to introduce it so you understand it's out there. Okay? And if you're selling some receivables at your first job and you don't know what to do, well, likely if they've done it before, look in the books in the past. Okay? Okay. I'll talk to you later. Yeah, see you guys. We'll just skip the last page. Okay, let's go to page 11. So, Whispering Winds sold $713,800 accounts receivable to Shamrock on a with recourse basis. So there's a guarantee, and it wouldn't be 100%, but a certain percent or whatever. Guarantee, let's just put guarantee action for the factor. Shamrock is the factor. Whispering Winds is the seller. Okay. And it's ASPE, and the risks and rewards have been transferred to Shamrock. Otherwise, Whispering Winds would keep the receivables on their books. Meets the criteria for a sale. No asset or liability components of the receivables are retained by Whispering Winds. So they assess a finance charge of 4% of the accounts receivable and retain, thanks to the recourse, an amount equal to 5% of accounts receivable. So prepare the journal entry for Whispering Winds to record the sale, assuming the recourse obligation has a fair value of $92.80. Okay, so right there you have to value the recourse obligation or liability for the seller. So that's going to take some calculation, some estimation. So we're not going to go into all of that. So let's start putting it together, okay? So I'm going to leave, we put debits first. I'm going to put 3 debits and 2 credits, just so we can put this together where how it makes sense. Okay, so let's break this down into pieces. So first of all, Whispering Winds sold accounts receivable and didn't keep any components. So that's the first thing we're going to do. Okay, we have to do. Well, AR is going to go down by how much? The whole thing. Now, Shamrock, going part, retains an amount equal to 5% of the accounts receivable. Okay? That's from the recourse. So, it said on the last point on page 10, seller records any recourse liability, the seller's guarantee, if it's sold with recourse. So that means the seller's holding on to some of the money, and we won't get it unless all our customers paid up. So let's do a different color. So this is number 2. And you guys, what order you do it in doesn't really matter, except cash is going to be last. So I'm going to leave this space for cash, because we know we're getting cash because we're selling our AR. Okay, but I'm going to leave it. Okay, so I want number 2 here. Due from factor. and it's a receivable. And this is the amount retained by factor for recourse. So 5% accounts receivable. So 0.05 times 713,800. And that works out to 35690. So, the third thing we have to do is the recourse obligation has a fair value of 9280. So that's going to be our recourse liability. That's number 3. That would be 9280. Okay, so this is a probable future payment for uncollectible receivables, income if all collected. Okay, now we've got something called loss. Remember I said usually you sell it at a loss? Sale of AR. And this is going to be part 4. And it's made of 2 things. It's going to be made up of the finance charge plus the recourse liability. So our finance charge, they says 4% of accounts receivable plus the recourse liability. And that's what we lost by selling the AR. Okay? So this is the present value of what they think they've estimated we're not going to be able to collect. So that's a cost to us, plus the finance charge. Now if everything is collected, the due factor comes back to us. So we're okay there. So it's just these 2 factors. So that works out, hopefully my math is right, 37832. Okay, and how do I do the cash? I just fill in the blank. And that, I guess, would be number 5. Okay, so I'm just going to talk you a little bit through it again. So what happens was we got rid of our accounts receivable. We got some money from another company and said, sure, we'll take them and collect them. Obviously, we will get more money and have less of a finance charge if our customers are all credit worthy or they've got good track records, or if we've worked with these people before and usually they pay up. So we get cash, we give away our AR. Now there's some little things we have to do. The guy or person, company we sold to says, you know what, I'm going to keep 5% of it just to cover some things if things go wrong. And we can do that because we made it with recourse. If we wouldn't have made it with recourse, it was totally without recourse, we'd have cash, we'd have AR, and we'd have some kind of interest expense for the difference between the two. Okay? But the recourse ones are a little harder. And you can look. So this is saying, okay, this is probably what we're going to end up owing in present day's terms, present value terms. That is how much they're holding back, and they're charging us 4% on the accounts receivable, plus of course we're responsible for this liability. So that's our loss on sale. Okay? Now, I suggest if you want a nice, simple, clear picture of this, you look on Investopedia or something. The text gets a little carried away and there's 42 different scenarios. So if you kind of want to understand how it's happening, that's a good place to look. Okay, again, not a lot of time on this. This is just kind of a straightforward picture of what recourse selling receivables with and without recourse is. Okay, here's some ratios you can use on these kinds of things. Introduce them, not because we're necessarily going to test you on them, just to remind you these belong with this. So let's say you're looking at auditing and you're trying to look for areas that could be problems in the financial statements last year to this year. Well, you're going to run some ratios, you're going to do some different calculations, and if you're looking at AR, these would be some things you're looking at. If all of a sudden day sales collected went higher and higher, or AR turnover got slowed down, something, is wrong. So you might want to look there. And I don't know audit side out, but that's generally. Okay, so AR turnover, average net trade receivables is beginning of the year plus ending divided by 2. And higher is more favorable. And day sales uncollected, lower, better. So if this was 36 days, that means that's how long it takes. How many days to collect? I'm losing my mind. Days to collect from the start of bringing in your stuff and selling it to collection. Obviously, lower is better. Okay, but again, it's also comparable. If you have a net payment period of 30 days and your day sales uncollected is 12, well, something's mismatched. Maybe you're being too strict on your credit policy. So you have to look at factors like that. And AR turnover is higher is better. If this said it was 12.62 times, because that's the units, those are the units, that means in the year, 13 times, or roughly once a month, you go from getting your stuff to selling it to collecting it. Okay? So, obviously you want to turn it over higher. Okay? And you can also do this with inventory, as you know. But it totally depends. If you have a 60-day payment period, because maybe they're bigger ticket items, something like that, well then you don't need it to be 12.62 times, right? It can be less than that. And of course you want to compare with industry average. So always remember, you guys, when you have ratios, you look at previous years, you look at industry stats, and always you ask why. Because, for example, all the